We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome back to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Rick Rule from Sprott USA. How are you today, Rick?
Tom, I'm fine and better for being on with you. Thank you.
Well, thank you very much. And we appreciate you spending the time with us here. Of course, we're speaking on Friday, March 5th. And you have recently announced that you are changing direction rather than functionally retiring. So can you fill our listeners in on what this change of direction looks like for you and why you're making that change?
I can. I've had a great run. I'm 68 years of age. I've been in the same business since I was 20 or 21. And I'm lucky enough to be at a position in life, having moved into my dream house, where I want to spend the rest of my life doing exactly what I want and none of what I don't want. I've had a spectacular run with Sprott. I mean, a truly spectacular run with Sprott. Being partners with Eric Sprott, being part of that organization has been, it sounds rude, but as much fun as you can have with your clothes on. I mean, it's just been absolutely spectacular. But several of my roles, I don't want to do anymore. I'm giving up my administrative and managerial functions, at least at the corporate level. I'm not good at it. I don't like it, so I'm not going to do it. I'm also giving up my regulated roles, anything that would cause me to come under the purview of FINRA. I understand the reason for regulation, but at this point in time in my career, I get more joy from non-regulated activities than I do from regulated activities. So I'm giving up everything that I don't want, and I'm keeping everything I like. I will continue to manage money. I'm keeping one private client. That's the Rule Family Trust, a client I know well and mostly like. I will both manage money and mentor money managers. And I will, of course, continue to mentor the wealth managers, the private client managers on both sides of the 49th parallel. I will continue too as a member of the Sprott Board of Directors. I am, and I suspect I will continue for a while to be the largest shareholder of Sprott, unless somebody buys a whole bunch. And I believe I am the largest private client at Sprott. So to say that I'm retiring from Sprott is a bit of an overstatement. I am shedding some roles that I don't think I'm very good at and certainly don't enjoy, which will allow me the time to both enjoy my dream house and also focus on the parts of the business that continue to give me great pleasure.
So, Rick, as you talk about the parts of the business that give you great pleasure, could you go into a bit more specifically about what those are and why you enjoy them so much?
I came into the game because I really like securities analysis. I like pulling apart companies. Looking way, way, way back in my career, I am, by training, a credit analyst. And doing things like that, the sort of green eye shade work that most other people hate, I like. I consider investment to be like a game of backgammon, but rather maybe a three-dimensional game of backgammon, and assembling information to make investment conclusions, not just information from myself, but assembling information from geologists, engineers, financial analysts, market commentators, competitors, and coming to a conclusion is just an awful lot of fun for me. And I found myself spending 30 or 35% of my time doing stuff that was less involved with investing than it was making Sprott a good investment. Necessary, but we filled out those roles. The other thing that I really enjoy now is doing this, educating and mentoring. In the first instance, I owe it to society. Early in my life, I was gifted with spectacular mentors who took an interest in me for no particular reason that I can think of other than perhaps my curiosity, but aided me immensely. And it would be very disingenuous for me not to take the opportunity to help younger people the way older people helped me. But the second thing is it's also very effective from a business viewpoint. When I look back over my last 10 years with Sprott, I would say that most of the money that we've spent in advertising has been at best less effective than I would have preferred. And all of the time and attention and money that we spent on investor education has paid us back in spades. A form of advertising where you give to the customer, knowledge, paradigm, rankings, whatever, before you ask for anything in return, is the most honest and the most effective form of marketing I know. It's also, for me, wholly pleasant. A side note, we thought as a while for an organization that we needed to determine how we could reach younger people. The resource crowd is mostly my age, which is to say, damn near deceased. And interestingly, through social media, we didn't have to reach younger people. They reach us. Mm-hmm. It's sort of funny that we thought about for 2 or 3 years how we were going to reach them. And then all of a sudden, they started reaching us by the thousands of their own volition, partially through media like this, of course.
Mm-hmm. And, there's a couple of points that you touched on there. And of course, being in this space for coming on almost 10 years for myself, I know that I have learned a lot from you. And it's interesting to think about it as a mentor, as you're saying, and, platforms like this and all of the other ones that you donate your time very generously to go on. That makes your knowledge much more accessible to guys like me that were coming up through this resource space. And of course, with the securities analysis, you are more than willing to give our audience your analysis of resource stocks. And we'll provide that link towards the end of the show. And you and I have yet to set a date for a real review and a discussion about that. But
I look forward to doing that. It's good for me and it's fun for me. You mentioned teaching. Teaching is a real form of learning. In order to understand something well enough that you can impart it, you have to understand it fairly thoroughly. And one of the things I've learned an awful lot about in the last year, receiving 22,000 inbound inquiries last year, was a lot to do with the way people think and the way people invest. And if you can make generalities about classes of people, you can assist people much more efficiently. You can understand the common mistakes. You can understand the common attributes that people have. I have learned certainly more than I've taught.
Yeah, I couldn't agree more, Rick. And I've learned that as well when I'm trying to explain things to people as part of this platform. Rick, the last time you and I spoke, you were telling us that there's 5 factors that would cause you to change your outlook on investing in gold. And one of those factors was a move up in interest rates. So as we've seen very recently, interest rates have in fact moved up. However, this is in reality negated by inflation. So can you explain to our audience why this isn't actually a negative despite the price action of metals this week?
It is a negative. It's just partially obviated, as you suggest. The nominal interest rate in the U.S. 10-year Treasury has moved from about 60 basis points to 150 basis points. And that's correlated very well with first the plateauing and then later the weakness in precious metals, much as we described that it would earlier. It's important to note that the interest rate is still negative. Using the government's inflation figures, the CPI stated rate of inflation, this number isn't from a cranky old libertarian named Rick Rule, but rather that august body, the Congressional Budget Office, they suggest that the currency is depreciating at 1.6% a year. So if they're paying you 1.5% and they are costing you 1.6%, what that means is that if you loan your money to the U.S. government for 10 years, they are costing you 0.1% a year, cumulative and compounded. In other words, you are paying them to take the credit risk and forestall consumption. Jim Grant calls this return-free risk. Over time, of course, time is on your side with the gold bet, not the interest rate bet. But markets act in the near term. We talked at a different point in time about volatility in precious metals and precious metals equities markets. What we have seen in the last 3 months is not anything to do, I think, with a break in the gold market. It has to do with volatility, downside volatility in a cyclical gold bull market. 20 and 25% declines in gold equity indexes in the context of a gold bull market are common. 10% declines are as common as you and I inhaling and exhaling. When you understand the fact that this volatility is inherent and has nothing to do with the underlying market, And you understand, too, the reason for the volatility. In this case, the rise, I would say, in the world's benchmark security, the U.S. 10-year Treasury. The circumstance that we're experiencing right now becomes much more understandable and much easier to either bear or take advantage of.
Mm-hmm. So, Rick, as we know, you're not one that believes in decades-long silver price manipulation, but you have spoken recently about how at times the future market trades up to 200 times the available physical supply per day, right? And if you put yourself in the shoes of the risk management department of a big bank that's holding a large short position, would give you real pause. So can you explain how the circumstances of this works and what the eventual outcome of the attention that the silver market has been receiving could be?
I could only speculate. I can tell you what my powers of observation have caused me to suspect for some time. All markets, all financial markets are from time to time manipulated. Market makers, as an example, are forbidden to sharpshoot, finding stray orders and filling them out of the context of the market. And it happens every second. Mm-hmm. All financial markets as big as LIBOR are manipulated. So the idea that a market as volatile as silver, as emotional as silver, wouldn't be manipulated is extremely naive. I don't see any long, thoroughgoing manipulation, but you see a circumstance where, as you describe, the daily, not weekly or monthly volume, but the daily volume in the futures market exceeds the supply of physical silver that secures it, the amount available for good delivery. And it tells you this is one of the most leveraged markets on the planet. 200 to 1, not aggregate, daily. Now, just suppose that some financial institution, say a bank or a big hedge fund or a country for that matter, laddered a short position in the silver futures market. And let's say that the silver's market was, as it is, highly emotional, highly narrative driven. And then let's say that big institution, which had, say, $1.5 billion bet on the short side in the futures market, borrowed and sold $50 million worth overnight in the physicals market. Sold it during a period of time when the volume was very thin, and they could achieve the greatest disruption of the market with the least amount of capital employed. Mm-hmm. If the consequence of that sale was to cause the physicals market to fall by 4 or 4.5%, what that does to the futures market in the out months or the out years is exaggerated. So if, as an example, if one borrowed on a 1-month term $50 million worth of silver to sell in the overnight physical market against a $1.5 billion notional short position, it's not impossible to assume that somebody on this short position could make $100 million against the interest charge on $50 million that they whacked the market with. Do you understand where I'm going with this?
Mm-hmm. Absolutely.
When you see these nighttime sales, when you see these large sales, anomalously large sales that occur during periods of time when somebody who was selling real silver that they owned to make money wouldn't be selling. In other words, where the probability of the market absorbing the silver was high, there can only be one explanation that I can think of in my mind. I remember too, because I'm an old man, I guess I don't need to tell you that, but I'm an old man. And I remember during the bull market in silver in the 70s that the market was frequently manipulated the other way, to the upside. Mm-hmm. I remember thinking as a young man, boy, the traders are having their way with this market. This gap up is really difficult to explain in any way other than people taking advantage of a tight market, which is, of course, what the Hunts sought to do. The Hunts looked at the activity in the futures market and they looked at the physical market, and they saw that demand for silver outstripped supply, except for in financial markets. So they decided to teach the shorts a lesson. Instead, of course, the shorts changed the regs and taught the Hunts a lesson.
Mm-hmm. So exactly as you're saying, Rick, one of the possible outcomes of this silver squeeze movement that some were speaking about was, breaking the COMEX. And you've said that dam won't break because they can change the rules as they did to the hunts in the 1980s, exactly as you were just mentioning. But what are some of the ways they can change those rules? And if they start to implement some of those changes, what is that, or will that be a sign of the precariousness of these positions?
Please understand that I'm not a securities regulator, that the comments that you're going to hear now are from an aged speculator. Mm-hmm. Please understand, too, that the COMEX is run for the benefit of the COMEX, not for you and I. And any supposition to the contrary is very naive. Were I a COMEX member that was facing structural difficulties within COMEX, the tools that would be available to me would be to change the margin requirement on physical silver and future silver longs and shorts. If, as an example, in the futures market, there is a 50% margin requirement, they could easily make it a 150% margin requirement, saying that the markets are too volatile. Mm-hmm. In a very strange set of circumstances where people held too much silver, too much from COMEX's point of view, or too many silver futures and asked for delivery, I think $200 million 200 million ounces in a real free market would cause the COMEX people to have a quasi-religious experience. What I think would happen is that they would declare force majeure, suspend the silver market, and say that they were going to go to cash settlement. Going to cash settlement at a price that doesn't exist because the market doesn't exist means that they have to fabricate a price. If this sounds like fraud, I think probably it would be fraud. I think that would be the likely outcome. But the idea that any group of us, any of us of the great unwashed, that think that we are going to spank the COMEX members is disingenuous. What is happening, and it's happening right in front of our eyes, I think, is that the control of the silver price by the futures market is beginning to be replaced by control of the market by the physicals. And this is really a sea change. The last time that we saw that in the market was really in the early part of the decade of the 1970s. The other thing I think is that the blatant manipulation and the excessive risk-taking by players in the market, including banks, is going to unwind. I think if I were a risk manager at somebody who was a big player in the silver market and saw the circumstance where a whole bunch of broke kids on Reddit could change the structure of the silver market and hand me a spanking of really historic proportions, among other things, do away with my bonus for the whole year, I would begin to change the practices of the institution that I worked for. Mm-hmm. And I think you're going to see that. I don't think that the regulators are going to act because I don't think the regulators are going to have to act.
Excellent, Rick. So as we know, the PSLV is one of Sprott's products that's gotten a lot of attention in this whole thing. So I'd like to ask you about the PSLV and under what circumstance you would have to close it to new money. And could you also explain to us the difference between an open-ended fund and a closed-ended fund and what the consequences of each would be?
Let's work backwards. We're not really a closed-end fund, which many people think we are. We can, if we have a valid prospectus, issue new issues from time to time, which we're doing, which is to say that the number of units that we issue is not fixed unless we're out of prospectus. We're in prospectus. So if there is sufficient demand on the market and if there are sufficient supplies of silver, we can sell new units and use that money to buy silver. In the last 12 months, we bought well in excess of 30 million ounces of silver. An open-end fund, an ETF, pinches and swells every day. They buy silver, they sell silver, or they accept deposit receipts or delivery receipts in lieu of physical silver. But because they have to accommodate both pinches and swells in supply and demand. For the specifics of our product, I would prefer, given that I am still a Sprott employee for 10 days, that your listeners consult our website. Suffice it to say that the assets of the Sprott Physical Silver Trust do not consist of delivery receipts and deposit receipts. There is no circumstance that I'm aware of where we would become unsecured creditors to a counterparty in the event of tightness in the silver market. I suppose, but I honestly do not know, that in a circumstance where we had a live prospectus like today, but we were unable to buy silver, that we would have to suspend sales of new units because we're constrained from holding anything other than good delivery silver and enough cash to run the trust, unlike our competitors in the ETF. The consequence of the difference between our prospectus and other prospectuses around the physical silver space, I would suspect, again, is one of the reasons for the extraordinary popularity of our product.
Absolutely, Rick. So as you're talking about, really getting that physical silver to put into the fund, has it become more difficult for institutions like yourselves to get the physical silver you need? And how do you think this could get resolved? Is it that higher silver prices, or do we need higher silver prices, or do we really need gold to lead the way?
I want to answer this very specifically. Okay, very specifically. Mm-hmm. We have every day been able to buy physical silver, institutional quantities of physical silver. The physical shortage in the silver business has been primarily in retail quantities, 1 ounce, 1 ounce product, 10 ounce product, even 1,000 ounce product. The demand for those products overwhelmed normal supply, and that supply was constrained because COVID shut down the refineries and mints that made retail product. At our level, maybe the largest physical silver buyer in the world last year, we have been able to buy institutional product. And as recently as 6 weeks ago, it was easy. It was a phone call. Now, we're very big customers, and so the dealers are even nicer to us than they might be to other good customers. But it was easy. Silver, unlike gold, is logistically difficult. If you were to go into the Royal Canadian Mint and see $1 billion pile of gold, it's disappointingly small. But $1 billion supply of silver is something very interesting to see. It's very interesting. So the first thing that happens is that you buy all the physical silver available in Ottawa at the Mint, because you can move it from one room to another. Logistically, that's pretty simple. Or Toronto, because you load it on a truck and put pallets into the Mint. If you run out of that, I'm speaking hypothetically, of course, this may or may not have happened at Sprott. The next place you might go where there's a lot of silver is Chicago. And so you buy a bunch of silver in Chicago, all that's good. And then all of a sudden it starts getting hard to find in Chicago because you bought too much. Then maybe you go to New York. But remember that we are physically constrained. We can't take delivery receipts, deposit receipts. We have to take the stuff. We have to put it in a truck. We have to take it to Ottawa. We have to unload it off the truck, and we have to put it in our little, or by now our big room. So the difficulty that I'm talking about is partly to do with the fact that it would be extremely inconvenient for us to go to Singapore or Hong Kong or Shanghai to buy silver. Silver is heavy, it's hard to transport. And when Eric Sprott set up these trusts, he wanted to eliminate any possibility of counterparty risk. So unlike other people who can trust intermediaries, we aren't allowed to trust. We have to have the goods. And it's become more difficult of late because of the extraordinary quality of our custody chain.
Yeah, I was going to say it seems a lot more difficult to, manage things the way that you guys do instead of just, changing a sticker on a pallet, right?
Yeah, if you were looking to buy a mortal's quantity of silver, 100,000 ounce deposit, 100,000 ounces of silver, and you were willing to accept the word of TD Bank or Scotia Bank or Barclays or somebody like that, and you were willing to accept a delivery receipt while your silver was being transported from Singapore or Hong Kong or something, you would be able to say there isn't a shortage in the physical silver market. If you insist on impeccable title, it's getting more difficult.
Excellent. So, Rick, I recently heard you say that you were thinking that the silver squeeze movement was inconsequential at the time, and you've stated that you've since changed your mind on that. So, why did you change your mind, and what lessons do you think you could impart to this new generation of people just learning about this space?
Three things. The kids caught the attention of the market. They really did. The market was already tight because the old crowd, that is to say, my crowd, has understood that gold moves first and silver follows. And we're coming into the part of a bull market where silver traditionally has gained preeminence over gold. It moves further and faster, but it moves after. So we're there. You started seeing disintermediation from the gold print to the silver print from traditional sources. Into that comes the Reddit crowd out of nowhere. They didn't buy much silver individually, but there's a lot of them. They bought a lot of silver, and they didn't do it the way that silver bugs do. Silver bugs go to the coin store and they buy physical silver. These kids went into the silver futures market, looking for as much leverage as they could get, absolutely fearless. And they handed some of the traders what could only be described, I think, as a religious experience. And they let the market know what can happen in the market with increased popularity. My suspicion is that this isn't the last time that the silver narrative plays in the public. It may not play from a short squeeze perspective, but the truth is more and more people have been introduced to silver. More and more people have been introduced to the silver narrative. If we assume that, and I'm not disparagingly calling them the kids, I mean, most of the world compared to me as a kid, but when these new investors came into the market in the size that they came into, what you're left with as a veteran like myself is that when most of them leave in search of some new narrative, psychedelics or whatever it is that attracts them, they're going to leave behind some of their population who, having been interested in the silver narrative, come to be attracted to the broader precious metals narrative, but stay in the silver market. And I think the silver market, as a consequence of this, is larger, broader, and more democratic than it was even at the beginning of 2020, which is an important change.
So, Rick, what would you say is most likely to push more institutional and retail investors into the space? Could it be the Fed stepping in with some sort of yield curve control, or maybe rising earnings of resource companies?
I think both help. It's interesting that we're in a point in time in the market right now where the gold price is falling a little bit, but the price of gold stocks is falling a lot. At the same time that their earnings, free cash flow, are rising rapidly. This is the normal sort of anomaly that you see in a narrative-driven market. People pay more attention to the story than they do the arithmetic. This is very common, frankly, it's where money's made. In terms of what takes the precious metals price higher, and hence the precious metals equities price higher, I think time. I think the wind is really truly in precious metal sales. As we've discussed in earlier interviews, precious metals prices go higher when people are concerned about the efficacy of savings products in terms of preserving purchasing power. Let's go through the list again. Quantitative easing, hugely popular with the electorate, hugely popular with both parties. Quantitative easing is counterfeiting, except for that they do it, okay? That isn't changing, it's accelerating. And it debases the currency. By definition, debases the currency. Debt and deficits. Two problems there. One, the credit quality of the issuer, which is to say the U.S. government. The second is the crowding out of other forms of borrowers. On a collective basis in the United States, between on-balance sheet liabilities and the net present value of off-balance sheet liabilities, we owe $160 trillion. And we aren't servicing that debt. We're adding to it by $3 trillion a year. Intelligent investors know that you can't add a column of negative numbers and come up with a positive sum. That number is unserviceable, debases the currency, calls into question the efficacy of savings. Do you pay it off with a default? Or do you pay it off by debasing the net present value of the obligation? Likely, politically, the latter. Interest rates, reversion to mean. Over 40 years, the interest rate on the U.S. 10-year Treasury has been about 200 basis points positive to the CPI stated rate of inflation. Whether or not you believe in the CPI stated rate of inflation is a different discussion. But if you use that as the numerator, traditionally there's been a 200 basis point positive premium to the CPI stated rate of inflation. Right now it's 10 basis points negative. Mm-hmm. The nominal interest rate has soared. It's gone from 60 basis points to 145, 150 basis points. The real yield is still negative. And my suspicion is over time, savers will look at this and say, explain to me why I should forestall consumption in return for giving back less money to consume than I gave. Mm-hmm. Jim Grant, as I say, calls this return-free risk. These very low interest rates, although this is ameliorated a little bit, provide another piece of wind in gold sails, which is to say that the traditional investment allocation among very large institutional investors worldwide has been roughly 60% equity, 40% debt. The idea being that when the economy is soft and share prices fall, that interest rates fall, and the capitalized value of an interest rate stream, which is to say a bond, rises in price. This works fine as long as you have a positive carry. But if 40% of your portfolio is giving you a negative yield, and you are forced to use that yield to guarantee the retirement of beneficiaries 20 years from today, you have a monster problem. 40% of your assets are liabilities rather than assets. And there needs to be disintermediation out of these bond portfolios into other asset classes. One prime beneficiary, I'm not saying a $40 trillion beneficiary, but one prime beneficiary is, of course, gold. Remember that what we're experiencing now. It has nothing to do with what we may experience 2 years from now. Mm-hmm. And the consequence of the increasing nominal yield on the U.S. 10-year Treasury is harmful to gold. Long term, as we discussed in an earlier interview, were I to see real yields that reverted to mean, which is to say 200 basis points above the CPI rate of inflation, I'd likely be out of the gold trade. Mm-hmm. I don't think they're going to be able to do it. I'm no economist. But what you see traditionally in credit markets has been that the U.S. 10-year Treasury is the bellwether. And when yields rise across the board, which is to say the 30-year fixed mortgage market yield goes up, which reduces housing starts and housing demand, politically very unpopular. Auto loans become more expensive, constraining people's ability to buy cars and constraining the auto industry. The prime interest rate, that is to say the interest rate paid by the largest industrial corporations in the country, which are credit quality, increases their cost of capital, reduces their earnings, theoretically reducing the stock market. And probably most important to the government, as federal, state, and local agencies roll over their short-term paper, they're forced to pay more interest on top of what is already a budget in deficit. So I don't believe that they are going to be able, in the intermediate term, to hold this interest rate. I think that they're going to be forced to manage the rate as they have before to artificially low levels.
So Rick, as you and I were talking before, obviously all of these five factors really have a tailwind for gold right now. But you were mentioning to me that there's a real malaise in the gold mining equities. And so can you explain to us why this is?
This is going to sound very, very arrogant, because most people are narrative oriented, mm-hmm. and not arithmetically oriented. They're going down because they're going down. People's expectation of the future is set by their experience in the immediate past. It's not set by history. Mm-hmm. It's not set by reading balance sheets or income statements. When stocks are going up, ironically, people find them to be Geffen goods. They want to pay more for them rather than less for them. One of the perplexing things in my career has been that if a stock goes from $10 to $20 and nothing has changed internally with the company, arithmetically, that stock is half as attractive because some of the upside's been taken away, but mm-hmm. people like it twice as much. If they bought groceries this way, if you went to the store and bought a loaf of bread for $1 and came back next week and it was $2, you'd buy 3 loaves. But that's not what you do. We buy bread much more intelligently than we buy stocks. Recency bias is very important. people's expectation of the future is set by their experience in the immediate past. And the fact that the stocks are going down means that people like them less rather than more. For me, it just means that a good that I want to consume is on sale. So there are 5 or 6 stocks that are on my shopping list that have been falling fairly rapidly. I own them, and I'm delighted. I'm absolutely delighted. Warren Buffett famously said, you shouldn't buy a share of a stock if you haven't done enough work understanding the stock that you wouldn't be delighted to see it fall 30% in price a couple of days after you bought it, so you could use the same intellectual capital to buy more stock. Now, I've been tested by this dozens of times in my career, Tom, but I found over time it's very true. Mm-hmm. It's very true.
So, Rick, when you go through the rating system of these equities, do you start to rate them as higher up on your list as the price goes down? Like, does that
Yes.
make the stock more attractive to you?
Yes. Yeah. I mean, I'm all about risk-adjusted net present value. I try to figure out what the value of the company is at various interest rates and at various commodity prices, or if they're speculative stocks, I try to anticipate the probabilities around successfully answering unanswered questions in exploration. So for me, all factors being even, a stock that falls in price is becoming rapidly more attractive. It's important to know that in qualitative rankings like this, in a hyper bull market, because my portfolio is risked, in a hyper bull market, the crappiest stocks do the best. So if I have a stock as a 3, which is a very high ranking, in a hyper bull market, a stock that's ranked as a 7 will almost certainly outperform the ones that's ranked as 3, because the fact that it's an unattractive company means that it's narrative driven and will likely do better in a narrative market. My ranking system is on risk-adjusted internal rates of return. In other words, it's a value-oriented ranking.
So, Rick, as you talk about how you've built that ranking system, what are some of the factors that you really weight heavily in and around, let's say, jurisdiction, or what are the most important factors to you?
People criticize me by saying that I don't take political risk into account. I do. I believe the United States is risky. I believe Canada is risky. I don't believe there's any good jurisdiction. I think the most dangerous government is the one that's closest to you. So as an example, the highest rankings I have in my portfolio right now are 3, although I think I'm going to upgrade to 2, several of them next week. Of the 3s, almost all of them are in Russia. Wow. Because those companies generate so much cash relative to their share prices, because the younger managers, the ones in their 30s, not the old dragons like me, but the ones in their 30s are so smart and are making such spectacular decisions. And because the development pipelines in those countries, in those companies are so much better than the development pipelines in countries that we're more familiar with, that I can't resist myself. Is Russia risky? Of course. My biggest experience with financial loss in terms of political risk occurred in Viceroy Resources with the Castle Mountain deposit in the People's Republic of California, the state that I lived in. So my worst experience in political risk happened at the hands of the Lotus Eaters in my home state. By contrast, I've done extraordinarily well investing in Congo, Eritrea, Serbia, Sudan. I'm not trying to say that there aren't risks in those places. I just think that the risks in places that we're comfortable with are much higher than we think. Mm-hmm. I think there are no good jurisdictions. There are only some that are better than others. And I think that the cover charge that you pay in the so-called good jurisdictions is unwarranted relative to the juxtaposition of risk between so-called good jurisdictions, of which I believe there are none, mm-hmm. and bad jurisdictions.
So as you speak about the risks in Canada, Rick, do you think, or what do you think the biggest risk is? Is it maybe mine nationalization? Like, as we know, Canada's debt to GDP ratio is something like 350%. So what are some of your considerations around the risks in, let's say, Canada specifically?
The Canadians are too polite to nationalize things overtly. They might do something like forbid a private buyer like China from buying it, which is to say that they nationalize some of the net present value because they take away the auction process. It might be that the regulatory environment that you exist in exposes permitting to public comment, which gives people who are nominally at least uninvolved in what you're doing a say in how you do it. But I think primarily it'll come down to taxes and fees. Even the so-called free market parts of Canada, if you think about Alberta 15 years ago when the natural gas price rose, they retroactively tripled the royalty. This is after extracting $1 billion in front-end fees for land acquisitions for oil companies based on the old fiscal regime. Understand that a government's job is to run a political auction. Mencken famously described elections as advanced auctions of stolen property. At their core, the government's job is to steal for their constituency, as they see them, from other constituencies. That's what they do. So the political risk in Canada is, let's say, as an example, that the gold price went to $2,000 and mining company earnings doubled. It isn't just that the government's prospective take would go up by the amount that the earnings went up. They would increase the rate of take. So nationalizing all at once? No. Nationalize on the installment plan. Put more, quote, stakeholders in place. Require more non-tax social expenditure. Increase the tax rate. Do you understand what I'm doing? Absolutely. The Canadian technique isn't so much to kill the frog immediately, but rather to immerse the frog in warm water and then turn up the heat.
Mm-hmm. Squeeze more money out of the frog, right?
Right. I mean, in terms of the parable, of course, the tendency of all societies is to slaughter the goose that lays the golden eggs. Our mutual friend Doug Casey once said that being a milk cow is bad enough, but you need to be very concerned when the taxing authorities begin to look at you as beef.
It's a great analogy there, Rick. So as part of your retirement, you said you were taking over Sprott Media. So will we see any changes to it? And when are you going to start working on that?
It becomes mine March 15th. The transfer of the infrastructure around Sprott Media is constrained by the competency of the CEO, which is to say me. And so you'll probably begin to see market changes in Sprott Media a month afterwards. But one of the things that's been frustrating for me at Sprott is because Sprott is necessarily bound by regulation, public utterances that I make under the Sprott banner have to go through compliance, which can often take 2 weeks. Mm-hmm. If there's a circumstance in the market that requires immediate comment, I comment on it immediately, and then I can send it out in 2 weeks. All that changes March 15th. And so I suspect that I'll be able to comment much more freely. I'm going to do an interview series that I'm really, really, really excited about that comes out of our conference, The Living Legends, where I interview CEOs who have built themselves major mining companies from zero to multi-billion-dollar enterprises. And in the course of these interviews, ask, as I do at my own conference, these people to describe to investors the lessons that they've learned building those companies, how it has helped them be investors, and what lessons that they have learned are applicable to other investors with their own portfolios. This line of questioning has been the single most popular part of the Sprott Vancouver Natural Resources Investment Conference for 10 years. And I really look forward to doing it online, although, of course, I would prefer to see everybody live in person in Vancouver. I understand that we can impart these lessons to 50 or 60,000 people per lesson virtually around the world. And I'm going to do a series of 12. I'm also going to do a series of questions where, rather than you question me, I get to question other people, called Other Voices, where there are newsletter writers, analysts, or investors who I think that have a lot to teach, and I'll interview them. So I'm looking forward to doing that. And I'm looking forward to continuing with the rankings discussion. I get great joy in teaching But too much of teaching is dry. The way that you get somebody's interest in an educational lesson is to make it relevant to them. And there's nothing in the world more relevant than one's own wealth and one's own portfolio. So by grading a portfolio and by commenting on individual companies, I can teach investing lessons to people in a way that is more palatable to them. And I look forward to doing that.
Absolutely, Rick. And that democratization of that information is something that I'm sure a lot of people are really looking forward to as a voice that has a lot of weight in this space, as you've become over the years. Rick, do you have anything else that you'd like to tell our audience before we wrap up here?
Well, I look forward to talking to your audience, both through my own channel, but also through your channel, in a much more forthright and candid fashion, beginning March 15th. That isn't to say I'll be outrageous, but I'll be free to say what I think, as opposed to being free to say what I need to think. I guess that's the right way to say it. And of course, I would invite your people to engage in a personal dialogue with me, beginning with a ranking. If your audience would go to sprottusa.com/ranking, you'll find a web form. Enter your natural resource stocks there. Please no cannabis stocks. Please no technology stocks. Leave an old man to what he does. I will rank that portfolio 1 to 10, 1 being best, 10 being worst. Mm-hmm. And I'll comment on individual issues where I think that my comment might have value. In addition, if in the question sections you care, enter the word charts, and I will include the Barron's Gold Mining Index, which I think is the best index of gold mining equities in the world. It's certainly the broadest, most inclusive, and longest running. And I will include too a 100-year commodity chart, which is a wonderful visual to see how cheap physical commodities are relative to other asset classes going back 100 years.
Excellent, Rick. We will put that show or the equity rankings in the show notes. Does that apply for public and private companies?
Understand that the database is limited to the number of companies that I believe either my knowledge or Sprott's knowledge is competent to cover. So if you have private companies in there that I'm not sufficiently well versed in to have an opinion, I will simply say no opinion.
Excellent. Rick, thanks so very much for your time today, and we look forward to speaking with you next time. You can be a little more candid.
Tom, thanks so much for the opportunity to address your audience. I've enjoyed the Palisade audience for several years now, and I look forward to interacting with you on a much more fulsome basis in the future.
Absolutely. I look forward to it, Rick. Thank you very much.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.